Hey friends, it's me, Micah, and this is the Homestead bandwagon. Thank you so much for hanging out with me today. Today's going to be really thrilling. I'm going to be talking about the wild world of tractor financing. Oh boy, buckle up those seat belts. It's going to be a wild ride. So right now it's 2023, in case you're a time traveler from the past looking into the future, or somebody in the future somehow watching videos made in the past, or if you're in the present right now, you may be aware that prices on stuff are up and interest rates are also up. Things have gotten quite expensive. And you might be browsing around for a tractor and hey, what do you know? You see an advertisement for 0% financing on a new tractor. That's incredible. Free money you can afford today to buy a machine that you don't have the money to pay for, and you won't even be penalized for making payments. There will be no interest for buying that machine, right? There couldn't possibly be a catch, could there? Well, maybe there's not a catch, but there's some things you should be aware of if you are planning on financing a tractor or maybe even a lawnmower, and to a certain degree as a car. I'm not going to get too deep into the weeds with car stuff. We're just going to stick to tractor financing. I was in the automotive industry for 12 years doing stuff on the sales side, and in the tractor industry now for about 6 years. I've seen a lot of financing come across my desk. I've worked with thousands of people financing machines. I think I've got some experience in this realm. So what's going on with 0% financing? How could it still exist when interest rates are sky high and prices are sky high? Are these banks crazy? No. But let's go to the past real quick here and just kind of get to know the history of interest rates. I promise it'll be only slightly boring. So previous to 1989, there was no governing body or system for credit, right? There was no FICO system prior to 1989. You kind of depended on your relationship with a bank, or, having lots of references, or just, slowly building credit with singular institutions. And coming into the 80s as well, interest rates were what we would now say very high. I looked at my grandparents' mortgage on the place we're at now. At one point, they were paying nearly 20% interest. That wasn't unusual on a mortgage. Now, we would think that, for a bank, a house and land is pretty risk-free. They can repossess it and sell it with ease. But banks were risk averse. They really didn't know you that well. So yeah, you'd put down half and have a 15% interest rate on a mortgage. That was normal. People were happy to be able to do that because it meant that they could own something now. That's how credit works, right? You can own it now, pay for it later. Okay, we get it. So coming into the 80s, interest rates were in the double digits. The prime rates, if you were a great buyer, were, 11, 12, 13%, maybe 15. I don't believe there are even lenders out there willing to lend for tractors. I don't know, but that's my assumption. And then this FICO thing happened, and all of a sudden interest rates started going down. And this was a benefit to the consumer. Interest rates, instead of being 12, 13, 14%, maybe you could buy a house and have an 8% rate. That's crazy, huh? How low of a rate is 8%? It's mind-bendingly low in the history of credit markets, at least in the US, going back into the 50s and 60s. It was an amazing rate. And that's where rates are at today. We're at the same rates as we were in the 90s. There was a couple blips in the interest rate radar. In around 2008, when we had the last financial crash, interest rates were around 3% for prime rates. And a couple of years ago, prior to 2023, interest rates did that again. They went way down to like 3%, which is a stupid rate. Why would a bank give you $20,000 and only ask for 3% back? It doesn't make sense. And that's what I'm getting at now. There is no such thing as a free lunch. These low rates cause buying frenzies, in my opinion, and historically we'll see this. People will start buying more and more and more stuff. All of a sudden there's more demand than supply. Prices raise, and people also go broke. They can't afford that house they bought that they felt they couldn't afford not to buy because rates were so low. So it pushes people to the market to have very low interest rates, and that's the point of these 0% programs, to push people to the market. And there can be a benefit to the consumer. If you're paying no interest on a loan, there's really no good reason not to buy that thing that you were going to buy anyway. You just don't have to wait 10 years to save the money. You can buy it now, finance it at 0% for 7 years. You don't have to have the cash in hand, right? So banks have to make money, right? They've got people they got to pay. They've got lawyers, they've got accountants, they've got secretarial staff, they've got salespeople, selling their products to other people. They've got, Xerox machines, they've got computers, they've got copy paper, they've got toner. You get my point. They got to have money. So how are they just giving away money at 0%? Now, some people may tell you, well, the manufacturer of my product, my tractor manufacturer, owns the bank, so they can give you a free loan. And that's either somebody who doesn't really know what they're talking about or is just straight lying to you, because a bank is a bank is a bank. They have to make money. They can't not make money. If they're not making money, they are not a bank. They are a bunch of people without jobs, basically, who don't have an income. You have to have an interest rate to offset the risk you take loaning people money, because not everybody pays you back. So how are they doing it? How are they giving you this free 0% loan? Well, somebody's paying for it, okay? So either the manufacturer's paying for it, or the dealer you're buying from is paying for it. That is correct. Somebody is paying to offset that free money you're getting. And this gives you an advantage as a buyer if you know that, because it gives you options. Some, not all, but some manufacturers will offer you cash incentives to not take 0%. And even if you don't have all the money to pay cash today for that machine you're buying, maybe you can take a slightly higher rate, have a lower starting price, and then you've got some options for how to pay for this thing. And it really, really, really depends on what kind of buyer you are. If you're the kind of buyer who buys something on credit and then just makes every teeny tiny little payment over the course of the full term of the loan, and that's an okay kind of buyer to be, then 0% usually makes the most sense. And of course you can compare 0% to what I would call standard financing with your dealer. If you can't compare it with them, maybe think about talking to somebody else if they're not willing to go to the work for you, but most dealers will. Now, if you're the kind of buyer who hates having payments, but you need the thing now and you know you're going to pay it off in a couple years, that 0% might not be a good deal for you. And obviously, if you're a cash buyer and you're receiving cash discounts up front to purchase a machine with cash, that's a great way to go. Cash is already 0%, right? But let's say you need to sit on the money for a little bit. You're flipping a house or something, and you're going to use a tractor to help you flip it. Then it may be beneficial, once again, to have a slightly higher interest rate, but to have a lower upfront price, because you're going to pay less for the machine overall. Let's look at the numbers here. Okay, now I'm obviously not a financial advisor or a guru by any means, but I've seen enough of these situations that I feel like I've got a pretty good handle on them. Now these situations might not apply in your state. Some states are not simple interest states. Simple interest being you only pay interest for every day that your thing is financed. So it's called per diem interest. You should probably know by now what kind of state you're in. If you're in the kind of state that preloads interest, this ain't gonna mean a hill of beans to you, really. Just either take the 0% and pay cash for your stuff. That's the only thing you can do. But most states that are not living in the medieval times have simple interest terms. It's a requirement that stuff be sold with simple interest. So that's what we're going to talk about right now. It's just some quick simple interest differences between paying a cash price and getting a higher rate versus getting 0%, but maybe paying a higher price up front. Here we go. So let's say we have a $20,000 piece of equipment, and if you want to finance at 0%, you lose $3,000 in discounts. So the price goes up by $3,000, okay? So we've got a $20,000 loan financed for 84 months at 8% interest. That payment is $311.72. So your total cost of ownership, if you make every single payment without paying any extra against your principal balance, without ever making big lump sum payments or doing anything out of the ordinary, just paying the minimum payment, you pay $26,184.84. That's the price of financing. That's how this stuff works. The bank gets a little over $6,000 of your money because they took a risk by loaning you money up front. That's fair. That's how things have worked since money was created. Now, if you pay the higher price, $23,000, that basically that extra money goes to the bank. That's who's paying for it is you. You got 84 months at 0% with a payment of $273.81. Now your total cost of ownership, $23,000 because there's no interest. So your payment's better at the 0%. It's $38 a month. And you've got $3,200 in interest charges that you saved, even though you paid a higher price, right? So you had $6,000 in interest, but that's offset by the $3,000 extra you paid for the tractor. So you're still saving $3,000 if you make every single tiny payment over the full term of the loan without ever paying any extra money towards the loan. So if you're a long-term borrower, that's a great way to go. You're going to save $3,000 and pay no interest and have a manageable payment. I mean, $273, that's my cell phone payment. Great payment there. Now, if you're the kind of buyer who pays stuff off early in that scenario, you know, by year 2, you got to have that thing paid off because you would have paid about $2,885 in interest. So that's how you win, right? You've paid less interest than you would have lost in cash discounts, if that makes sense. So at year 2, you better pay that thing off. So you go out, build up a property, flip it, take your money, pay off the tractor. You've won as long as you do it within 2 years. Now, the reality with these 0% programs is that they're not quite as simple as just signing your name on a piece of paper and giving nothing and getting a tractor in return. In most cases, the banks will require like 10% down, or if you live in a state where where you pay sales tax, they won't finance the sales tax. Or let's say there's an implement you want, but it's not a co-branded implement, you know, so it's not a Kubota Land Pride implement. You need something better or something different. They won't finance that at the 0%. So you'll either have to pay for that thing in cash or they'll hike your rate to offset that. They call that a blended interest rate. So we're gonna say that in the same scenario, $20,000 machine, if you're paying cash, you're gonna put $2,500 down because at the 0% price of $23,000, they require a down payment. So we're gonna put $2,500 down in this same scenario. So now with the standard rates or the higher 8% rate, you're financing $17,500. So now you've got a payment of $272.76. So that payment came down quite a bit by putting $2,500 down. Your total interest you would have paid is about $5,400. So the total interest you paid is down quite a bit from the previous scenario. You know, about $600, something like that. How much? Yeah, about $600-700. Not bad. So in the 0%, $23,000 financed with $2,500 down means you're financing $20,500. So you're financing more up front because you're getting that low 0% interest rate, and your payment's $244. So your payment's still lower than it was with the interest rate. So it's a better deal overall. Your cost of ownership is lower overall if you make every single little payment without paying extra. But again, if you like doing big lump sum payments every year to pay down your loans, if you like to pay extra on your loans every month, that math kind of gets a little more gray, because now we have a $28 a month difference, and you're saving only about $2,400 with going with the 0% versus the standard rate at a lower price. So which one of those deals is better? You know, if you're making extra on your payment every month, you're going to buy that principal balance down. You're going to be charged less interest per month as well. All of a sudden, taking that lower price up front might be a good deal for you. And that's why you've got to know thyself, know who you are as a buyer. Now you can completely beat the 0% by putting $9,000 or $10,000 down. All of a sudden then the 0% doesn't make any difference. Your payments are exactly the same. Your total cost of ownership is exactly the same. So keep that in mind too. If you're the buyer who likes to put down a big lump sum and have a tiny payment, maybe that 0 doesn't make sense because again, you may be able to get a lower cash price. And sometimes all you have to do is talk to your dealer. You know, you might be working with a dealer who's just used to everybody coming in foaming at the mouth for 0%. They're not used to offering the cash discount to people. Ask them, say, hey, is there a way I can get a cash discount on this for accepting a higher interest rate? There might be. They might just not be used to it. Ask them to go look it up. They might not know. They might, like I said, be so used to people coming in wanting that 0 and only that 0, that all they do is offer the higher price. And a good dealer, they'd be more than happy to let you pay a lower price if they're not being penalized for you getting a low interest rate, because maybe they're paying to have that interest rate lowered to 0%. That's not uncommon. So what I'm saying here is work with your dealer, go in with some knowledge. Also buy within your means, don't just buy something just because it has a 0% on it. Make sure you can afford it. That's important to do. And also, if I could give you a small suggestion, look for a win-win. There is no good reason to go out there and try to gut your dealer. To go to your dealer and try to make sure they're not making a single penny on you, because if your dealer doesn't make any money, they won't exist anymore. And you could say, yeah, I'll let the next guy, pay the price. But that's kind of mean too, man. Would you, go to Starbucks and steal a drink and then let the guy behind you pay for that drink because you decided you didn't want to pay your fair share? Of course you wouldn't. So why would you do that to somebody buying a tractor? We can all win. You can win by getting a decent deal on a tractor at a price you can afford. And your dealer can win too by making a profit on that machine so that he or she could exist for the next 20, 30, 40, 50, 60, 70 years and serve you and your family, to give you parts support, to give you service support, to give you good advice. So again, I encourage you, look for a win-win when you're buying your machine, and go in with a little knowledge and ask your dealer, hey man, how can we find a way for this to work for the both of us? And I think if you go in with a positive attitude and an open mind and armed with a little knowledge as well, you can put yourself in a great position that maybe you wouldn't have been in had you just charged in and just taken the first deal you looked at. All right, well, y'all take care of each other. Be kind. We'll see you soon.